Most entrepreneurs think they'll be great investors. Usually, they're wrong, because building a business and investing in one require almost opposite instincts. As an entrepreneur, you have to be optimistic. You have to believe problems can be solved. You have to push through chaos. But as an investor, that same optimism can get you killed. Today's guest is Justin Donald, founder of Lifestyle Investor. He's built companies, bought businesses, raised capital, invested as an LP, and studied how family offices actually protect and compound wealth. In this episode, we talk about scaling a service business to institutional clients, why fast growth can almost bankrupt you, how working capital sneaks up on operators, and why entrepreneurs often invest like operators instead of investors. We also get into family offices, asset allocation, legacy, and how to think about wealth after the exit. This is a conversation about making money, but more importantly, not giving it back.
Hey, thanks for having me, Jay. I can't wait to hang and talk, do all the things that we chat about behind closed doors or at dinner meetups and stuff. So like we did in Miami.
Exactly. It's just a continuation of our conversation. So I love it. So let's do a little bit of an intro. Can you tell us a little bit of your story, and then we'll start from there?
Yeah, sure. I guess I'm an investor entrepreneur. I got started early days, with a small business in high school, and as I graduated, kind of started another, new smaller business. And, over time, I just kept growing that. I mean, early days for me, I think my first real business was a real estate company that I started to build in the mobile home park space. And then we expanded to single family homes and some storage units and a little multifamily. And then, and I started becoming more of an LP investor in a lot of things. So I wasn't actually, early days, I ran everything. And then I started kind of diversifying away from that. And then in the process, started a single family home maintenance company because I saw the trend of what was happening when we were trying to buy single family homes from courthouse steps during auction, and people coming in from the institutions with backpacks full of cashier checks that were blank and could buy every home there and did and outbid everyone. It was like, ooh, we can't really hang in the home acquisition. Plus, it's a big float, to do that anyway. So then I was like, well, what if we built a company that basically did all the turns and maintenance and rehab work for these large institutional investors? So that ended up growing and becoming very fruitful, and likely we'll probably have an exit. We brought in a VC and they brought in a professional team. So, I haven't been involved in it in years now, but
Oh, nice.
I think it'll likely have an exit next year, Q2, maybe Q1, Q2.
Oh, nice. So how long so you ran that business for how long before you had an investor come in?
So we ran it for probably about 3 to 4 years or so before
Okay.
having, institutional money come in. We had S3 in here in Austin, where I'm from, the biggest VC in town, really expressed some good interest. We had a few groups, but and one of them actually tried trading terms and just creating the worst deal in the 11th hour, the day before we were supposed to close, and we just walked on them because we had other people in the pipeline. And S3 was like, hey, I'm not going to say who the VC was, but
Yeah.
there were some bad ones out there. And S3 came in and they're like, hey, we like the deal. We'll do it. We'll do it on the terms that we discussed, and we'll actually close on those terms, which they did, to their credit.
Oh, that's awesome. So what year was it when you started this?
So that was in 2015 to 2016.
Okay.
Probably end of 2015, I think.
Okay, so that's like the days when the open doors and Redfin start buying houses direct, and then everybody was, BlackRock, Blackstone, BlackRock,
Yeah.
everybody. Okay, that makes sense.
That's right. Yeah. So,
Okay.
early days when we were buying single family homes, that was years before that. Like, you just saw all these people coming in. And so, by the way, the irony is Blackstone was our first big client. We had some smaller ones, but they had built this. They were buying thousands of homes at a time. I think they had built up to 80,000 homes or something
Wow.
at that time. And I just knew, we have our mobile home park company, right? And
Yeah.
so we had built rehab crews and, maintenance crews. So we had teams that would run those, but it was hard enough in one single location to have an operation that covers it, let alone different cities, different states,
Yeah.
And
Yeah.
so I was like, there is just no way they're going to be able to do this in-house. And they were trying to do it in-house. So it was super obvious they were going to need to outsource some of it. And it was right time, right place. It was really
Okay.
a win-win.
Yeah, it makes a lot of sense. I remember those days because I was early in Zillow headquarters when they started buying homes themselves,
Okay.
and I'm seeing this one guy that they transitioned from being like a talking to real estate agents selling them leads to now he's buying houses.
Yeah.
And I'm like, well, how are you doing it? And how are you pricing? And I'm like, oh man, you guys are gonna lose so much money. And eventually they did that. They lost billions of dollars and they got out of that whole, buying houses thing. And but I can see like you guys made the smart pivot where these guys are gonna need services. Let's go help
Yep.
them. And so were you able to scale with that operation pretty quickly?
Yeah, it scaled very fast. Now, I mean, eventually we hit a plateau, like around 10 million revenue. And we kind of needed, new systems because we had bottlenecked and we probably needed like new strategies. And we were building a new software because the software that once worked on the smaller scale didn't work on the larger scale. So, but we ramped really fast. I mean, we got 5 million in no time and 10 million shortly after that. So,
Wow.
uh, yeah.
That's cool. So is with the way the economy went, interest rates, and I'm assuming the buying cadence had slowed down. How did that affect that business?
It's an interesting thing. So you still had so our goal was to get the big groups. It didn't necessarily have to be an institutional owner, but did you have at least a 1,000 to 5,000 home portfolio? Like that was kind of our sweet spot. We had a bunch of clients that were over 10,000 homes. We had two or three like pretty monster clients. And so if we ever screwed anything up, you could feel the hit because, it was a lot of volume coming from a few of these groups. But yeah, I mean, the sweet spot was find the people that had the need. And then it didn't really matter if they were buying more homes. Of course, it's better if they do, but at scale, when you're at 1,000 homes, so let's just take like, one of the smaller groups out there, and that sounds big, but to everyone listening in, it's in that space, it's you're a really small fish at that volume. You're not doing this in-house. It's
Mm.
just not, you're going to have a hard time even in one city because it's multiple locations in a single city, right? So it is anytime that you've got a decent sized portfolio, you're going to need the help. So whether people were buying or weren't buying, it really more depended on portfolio size. And then also, it wasn't like they said, hey, here's every city in our portfolio, go. It was kind of like, hey, let's start here in, this city. And once you prove that you can handle this, we'll open up another city. And so we would just kind of slowly grow the market presence over time.
So like land and expand.
Yes.
And so are all the employees your employees, or you're using subs and you're just doing the management or the management layer on top or
So it
in
was
between?
both. Yeah, we had so our in-house, like our logistics team and our executive team were all in-house, they're all employees, and we built the employee count probably up to about 50 to 75 people in pretty short order. I mean, we may have peaked at one point at like 100. And then our subs were a lot larger than that. I mean, we had grown the subs to about 200 in pretty short order. And then anytime that you would, kind of turn on a new market, we were just ramping. But for most of the time, I would say we were like 50 to 75 employees and 200 to 300 subs.
So as long as these property owners or these funds own these properties, you really don't care about the growth of the portfolio because there's maintenance going all the time. There's
All the time.
turnover. There's okay, got it. It makes sense.
Yeah.
It makes a lot of sense. So what are your thoughts on? There's a law coming out right now. What is it? The housing law that's trying to get passed right now. What are your thoughts on that?
You know, um, who knows? There's doom and gloom around everything, and
Yeah.
who knows what's actually going to pass. And everyone thinks they know what's going to happen. I don't know. I've just gotten to the point where it's hard to predict what's going to happen, and then it's hard to predict even if it happens, what's the outcome of it.
Yeah.
Anytime new legislation comes in, there's always unintended consequences. So I
Yeah.
think we all know that. How great are those? I don't know. I mean, I don't think that it's much of a concern just based on who we're working with, size, all that. But you never know, and
Yeah.
markets change, and people sell big portfolios. But as long as someone's buying them, as long as someone needs servicing,
Yeah.
and we also like we tweaked our approach. Like at the early days, it was like, yes, whatever you want, we can do it. Can you do roofs? Yes, even though we didn't know how. Can you do, slab leaks? Can you do electrical? Can you do garages? Can you do fencing? Can you do pools? Can you? And so we just said yes, yes, yes. We screwed a lot up along the way, but because we serviced all the trades, we figured out what were the highest margin trades that we wanted to do, so we could specialize a lot more. We found the cities that were easiest to hire work and specialize. So we actually cut down on the cities and actually put more energy and effort into certain cities to grow our scale that way. So early days, it was like, yes, we do everything, and yes, we'll go to any city. But the more calculated approach was the better approach. These are the trades that we do. These are the markets that we're in. And we're going to be more methodical about adding new trades and new markets. It's got to work. And so that shifted over time, and that was good because it really, when these institutions said, okay, we're turning the spigot on, our model broke many times.
Yeah. So volume is not always a good
No,
thing. Yeah, it can
no.
kill you.
Oh my goodness. I mean, we could have gone out of business so many times because of us. So it seems like a good thing more, but these guys pay you, in the early days, we were getting paid on like a net 60. And it's like,
Mm,
we can't float these this
right.
long. And so then, and you would go back and forth on pricing. Eventually we would negotiate like set pricing for different things. We'd get down to like a net 15 or a net 30 for payment. So we cleaned a lot of it up, and we got better over time, and we just got smarter about the operation.
That's a big so give me some of the top lessons from that. That's a huge one because we see a lot of entrepreneurs, especially the ones that do acquisitions now, that are not familiar with, these challenges of working with large clients, not necessarily institutional, but any type of large client, all these challenges with volume because they think it's a big, juicy account, and they get excited. So give us some of those lessons.
All right, so you're going to have to pay your subs every week,
Yeah.
right? Like otherwise they're gone. They are
Yeah.
just in the wind. And so if you increase volume and you do all these jobs and you're waiting 60 days to get paid, well, now you're front loading all this cash to keep your crews ready for the next jobs.
Yeah.
So if you can't pay them, or you got to delay it a week. I remember we moved from 1 week to 2 week, and that was not good. Like that was a total train wreck. And so it was like we shouldn't adjust over there. We should adjust over here with the institution. So I mean, I feel like we made every mistake in the book, but we didn't have a huge float. I established a credit line. That credit line would go fast.
Nice.
We treated it like a revolving line of credit where we're just always paying back, always paying back. But we found ourselves in situations where we did not have the cash sometimes. We would have to last minute raise money. We'd bring in investors. It wasn't like we thought you grow no matter what. Grow the top line. And that was a poor strategy. And then also our internal systems couldn't handle the volume either. So from a logistics standpoint, it became harder to route people and had to, create different departments and different tiers and who's doing what. Do we have a main point person that oversees it? Do you have several point people? We got to the point where we recognize we need in-house maintenance expertise that can correspond with the people out there because some of us didn't have the depth of knowledge that we need for like a slab leak, on some of this plumbing stuff. Like you kind of need a plumber that knows what's going on. I can handle some stuff, and my partners knew some stuff, but not like expert level. So yeah, I mean, just the slow, methodical growth was the better plan, and I wish we would have realized that sooner.
So you would have taken a slower path. You would have But again, you don't have the data to know exactly what
That's right.
trade, what area. So you only get that data by actually doing the making the mistakes. And
Yep.
I know, so sometimes there's certain things you can plan for, but not everything. And that's the go ahead, sorry.
Yeah. Well, and I was also going to say same thing on the real estate business,
Yeah.
right? So like if you acquire too much, there's a float there as well. It's like you got to buy this, you've got this note payment due here,
Yeah.
you've got these subs that you owe. So it's fascinating how similar those trades are. So
Yeah.
you would think, oh, we bought more properties, we're going to
Yeah.
cash flow more.
Yeah.
But it didn't always work that way. And then certain properties had more needs than other properties. We were understaffed in certain areas, overstaffed in other areas. And so there is like a sweet spot to it all. So, the quick and another thing is like, on the real estate side, I remember I was like, well, we got to do whatever it takes to grow. And so I would buy properties with thinner margins. And I was like, well, it'll all work out because we've got a big cushion on this one. But then there's like, oh, this capital, event, some sort of a, like, I don't know, one of our properties, we had a tornado go through it. So it's like, luckily it didn't hit any of the homes, but it ripped
Yeah.
up trees. But it's like, thank goodness we had some money set aside for that. But, um, so now you're shelling out money for these expenditures, and that was the money that you had set aside for paying the staff,
Yeah.
right? Paying some of these subs for doing rehab work or turning homes. And so it is interesting. And I remember one time we got so thin that it was like, uh-oh, we went from positive cash flow as a portfolio to negative cash flow as a portfolio. And so we're just kind of keeping up. And I didn't forecast that properly. I didn't forecast some of the occupancy numbers, some of the additional costs. We didn't reserve enough for capital expenditures on a couple of properties. There are a few skeletons in the closet that uh, sellers were not honest with us about that we didn't figure out during due diligence. So, yeah, all kinds of stuff. But yeah, for me, the slower growth just makes a little more sense.
Well, it's interesting because I have a background experience in manufacturing goods and selling them to large retailers, and then I went from that experience to another experience where we had a fleet of containers that we were renting for retailers, and they were essentially two completely different businesses, but they were actually very similar because it was essentially a certain amount of capital that you convert into a product or a fleet that you have to turn a certain number of turn to generate cash flow. And so for
Yep.
us, in the retail space, we needed to turn that cash maybe like 3 times. In the fleet, we had to turn it like 4 or 5 times. And every year we have to turn that capital that many times. Now the focus for us was the speed of the turn, but also the margin, the unit economics. So it's the
Hmm.
same in if you're buying real estate flipping properties, you have a certain amount of capital to play with. You're gonna
Yep.
go buy a certain number of assets that you're trying to fix and sell as quickly as possible while maintaining your margin.
Yep.
And then so
A
you
hundred
have
percent. And then and
so,
then you have an insurance claim that they say they'll pay in 30 days, and it takes them, almost a year, which happened in our case. And you got to float that. It's not like we can just let this go and not fix this stuff. So it's
yeah,
like, and then because, it's so crazy. Like we've been great customers of these insurance companies, no claims over a decade. Everything's great. We make one claim, small little mini claim, then they don't want to renew you.
uh,
Oh, it's crazy. So, we dealt with some of that too and had to find different providers, more expensive, but it's all about the learning, right? You
yeah,
learn this stuff, you do it better the next time, you figure out, oh, should we have not made a claim? Should we actually maybe this time we would have been better just going out of pocket here,
yeah.
in the in the long term versus what we thought we were going to get in the short term. So fascinating stuff.
Yeah, and that's why, I mean, that's why a lot of times when we talk to business owners, or when when we're doing discovery to acquire a business, a lot of times when you ask for the arc of the hero's journey of the entrepreneur when they first started, and they've been maybe in business for 30 years, there's a period where they push growth to the max. They say, okay,
Yep.
I know what I'm doing now, let's grow. But then they hit that ceiling, and then there's this turbulence, and then they think to
Hmm.
themselves, hey, I remember when I was, let's say they're at 10 million, I remember when I was at 5, I was making this much money, the same amount of money that I'm making at 10, but now I have all this headache.
Yep.
Let me come back down to 5, and then just enjoy life.
That's
And
right.
so every entrepreneur usually hits a ceiling of their capacity to run this business at that sweet spot, where he's making it enough money, the people are happy, the clients are happy, and there's not that much headache. It's predictable. The business become predictable. And
That's right.
then and so so for you guys, you got to a certain level, and they said, okay, for us to make to the next stage, we need more capability. We need
Yep.
to partner with a VC. And so how did that transition? So why did you make the decision, and then how did that evolve?
So I think there's, a couple things here. My partners and I were at odds also. Like I really was more excited to scale profitability. My partners were really more excited to scale revenue. And at that time, you were rewarded for revenue, right? We were able to take a services-based business, lay in some proprietary technology. It was like one of the only moments in history where you could actually become a tech company, even though you're a service company, right?
Yeah.
And so we had the ability to, get a higher valuation because of that. So it kind of made sense. Like let's keep going down this path. And then we also felt like if we had the cash, we could just turn on so many markets. There was so much that we could do. Um, and then also to a certain degree, like I don't think anyone wanted the VC to kind of put their own C-suite in, or I should say in the beginning. I was pretty okay with it at a certain point because I felt like some of these hired guns just had more experience than our crew. Certainly in many veins had more experience than me. So I was pretty comfortable with it. I think my partners were not as excited about that. And, eventually they, kind of brought in everyone they wanted to bring in to kind of run it. And none of the founders are actually running anything. I had stepped away, probably a couple years before that, uh, but their playbook is it is a replicable playbook. It has worked for them in other industries, and I do think they knew a lot more about the big game than we did, and they knew how to get there. They knew how to get other financial partners. That I mean, if you're gonna raise money, find a good group that not only you get Series A, but they can help lead the Series B, and so on and so forth. And so from that standpoint, it was really good. But things change also. When you make decisions with, 3 or 4 people versus like now you've got, a board, and you've got, the VC's team, and you've got an independent, and you've got, your team. It's things change. The business changes, the politics change, the way decisions get made changes, and it becomes a different business. So there are
And
pros and cons.
yeah, so you have this capacity to raise capital. I'm assuming operationally, did you guys get better or the same?
I think operationally we got better. I
Okay.
think they brought in more in like oversight that helped us get better as well. I mean, to a
Okay.
certain degree, more capital was going to help us get better. But I think we became inefficient,
Yeah,
and
that's what I was
so
gonna say, because
yeah,
that's coming from somewhere, what I mean, so you're gonna
yep,
pay for it somewhere. So essentially you're forgiving, like, the foregoing margin for growth.
yeah,
And then
that's
so you bring
exactly
in,
it.
okay, got it. And so eventually did you sell before COVID or during COVID?
So this business is still, so I took some chips off the table early days, pre-Series A, and then in the Series A. But I still have equity today. It hasn't fully sold. But I think we will soon. But I like kind of taking chips off the table, every step of the way. That to me is just I don't need to maximize any single thing. I just like getting as many wins along the
Yeah.
path as
It's
I
also
can.
a value time of money too, as well.
For sure.
But did you start investor, VC deal? Did it come before COVID or after COVID?
It came right after COVID.
Right
Yeah.
after COVID. Okay. So, and then I'm assuming there was like the COVID bump. You guys
hmm
grew, and then is it stable now, or is it still growing, or how
Well,
is
it's
that?
interesting. So what ended up happening is like a full like 180. So instead of being focused on growth at all costs, it was let's get back to profitability. So it's funny because this is really where I'm more comfortable. And so it was let's reduce our markets,
Hmm.
let's reduce even more our trades, let's cut our team and our staff down. And at one point I was like, they're cutting how many people? Like what percent? There's no way that we're going to be able to do. And I'm telling you, it's the craziest thing. Like we're doing just as much as we were doing with half the people, less than half the. I mean, I think it was literally like a 75% staffing cut.
Wow.
And so it shows, and I mean, it doesn't always work this way, but it does show the expertise. It shows like, people that have done this before, like what type of infrastructure and personnel do you really need to get the revenue you're getting? And I don't think anyone would have thought we could have gotten the revenue with that small of a staff.
Wow. So the top line didn't change, margin improved, the business got efficient. So so they essentially are getting the business ready in shape for, an exit a year or two from now. That's
Yep,
the kind of the plan. Okay,
that's
nice.
right.
And is everything is on forecast, on
Yeah, I
plan,
think
on
everything
track?
looks good. I mean, I do think revenue took a little bit of a hit, but profitability went through the roof. I mean,
Okay.
it was tight every month, and too much was being spent to run it.
Yeah.
And now it really is humming along with. So now I just feel like we're in and I'm not like super involved. I don't know all the details today
Yeah.
like I used to. I haven't really been involved. I'm not even paying attention to the financials. But it's like the foundation's built so that we can have more scale and with better margins.
Nice. I almost feel like getting a business ready for sale is like getting somebody ready for a bodybuilding competition. They got to go
Right.
through a period where they're going to eat a lot and overconsume a lot of calories and push a lot of weight, and then there's a cutting period where it's like
Yeah,
miserable, and it's
that's right.
like so. But then you peak at a certain window.
Yep.
And that's
Fascinating,
like
right?
yeah,
It's
that's
totally
your
like that.
yeah, that's your best shape. So it's kind of different. It's different seasons, different stages.
Yep.
Yeah. So now having that operational experience and having gone through that cycle, how does it make you like how does it inform you as an LP?
Yeah, so it's interesting because, you know, so I've operated a number of companies, right? I've operated a real estate company. I've operated this maintenance company. I've operated a handful of other companies
Yeah.
over the years. I've done some franchises. I bought some mom and pop companies. And so I've also learned how to plug people in. And it's what's interesting. I had a mentor share with me, hey, Justin, just because you're a good grave digger doesn't mean you need to keep digging graves. And that it was like such a great lesson for me where it's like, yeah, I'm good enough to be an operator, but that doesn't mean I should keep operating. And it also doesn't even mean I'm the best operator.
Yeah.
And so I just had this epiphany that like someone can do it way better than me who actually enjoys doing it. I got to the point that I wasn't enjoying doing it.
Yeah.
And then I can actually like have more life, lifestyle, just buy my time back. And so that was like this huge aha. And by the way, I also acted as like a CFO in a number of businesses. So my financial acumen and know-how is good enough to like do a solid job. And sometimes the things that you're competent in that you do well enough at, it's hard to hand those over,
Yeah.
right? And so it wasn't until I hired a CFO where I was like, oh, I'm not even close to good at this. Like
There's
I
another
got us
level.
where we needed to go, but this is way next level. There's no way I'm even in the same sentence as someone who's specializing here. And oh, what a joy. I don't have to do this anymore.
Yeah.
And I have peace of mind because this person's better than me. So those are two instances where I've been an operator and I've been, kind of in charge of all company finances and everything from that standpoint. And I just realized, wow, I can hire high quality people. They can do it. They can do it better to me. They're good at it. They enjoy it. I'm not as good. I don't enjoy it. It was keeping me from it because I was good enough. But now that I bought my time back, I can spend in a way that's way more enjoyable on the things that, like, I'm big vision, like you are. Like I enjoy that. I enjoy thinking that way. I'm also a teacher. I like to teach people things. I like leadership development, and I'm a great culture setter. So it's like I can do these things from a support role, but I don't have to actually be running the day to day.
Yeah. Yeah, no, 100%. And that's the part that's tricky about the game of business is that even though, we know other companies, we see other companies, but we don't really see like how the game is played, at a higher level. A lot of us are, when we're running or building our businesses, we're like in our bubble. You're trying to focus, you try to survive, really,
Yep.
you may
Yep.
have goals, but you're grinding. You're not looking at how other people do read their balance sheets or their P&L or how and sometimes just little tweaks can change the business. Just the way you look at your business can change. Just the way you look at your P&L can change everything, and we don't get that chance to see how the game is played in other companies at a higher level. So yeah.
Totally agree. Totally agree. And once I had cracked that code, it was like, wow, why am I not just hiring an operator for every business? Why am I not just hiring a CFO or a head of finance for every business? And then that became the playbook, right? Like if I'm going to put money into something, I don't need to run it. I don't need to head up operations. I can put in the right people, the right team. We can do amazing things. I can have oversight, but I can just get out of the way.
Yeah. So tell me about one of your favorite businesses. Like, give me like an example of one that where that playbook worked exactly like you thought.
Well, so I ended up buying a dog training company with some friends, and kind of a cool story because Patrick Mahomes trained his dog at our studio. This was in Kansas City
Oh, that's cool.
when we owned it, and we had a UFC fighter and number of different people. So it was like kind of a cool situation. Now I know nothing about dogs. I've never owned a dog. Okay, I literally don't know a darn thing about how to train a dog. But we bought this business that we noticed there was no SEO. So we started tweaking the SEO. The systems were pretty weak. So we kind of created better systems. We noticed that they were only opening up 1 month at a time for Windows to do training. So we hired more trainers and opened it up to 6 months and got to the point where we were like backlogged. I mean, like we had a wait list. We at one point we were doing like 10,000 revenue a day,
Wow.
just growing this thing to like max capacity of 6 month windows. And so that was a really neat one. I brought on a partner who, so I put the money down to do this. And then we got an SBA loan on this. And then, I could have easily just said, hey, I'm, 100%, here's Phantom equity, or here's, 90%, or here's 80, I'll take 80%, you take 20% or something like that. But I wanted my partner, who is also a friend and also, a mentee of mine, I wanted him to get out of the rat race. And so I was like, well, what if we just do this so that you have, the same equity ownership as me? And I actually think I did it lopsided where I gave him 60 and I had 40. but kept kind of voting control, is what I think we ended up doing. And anyway, we did great with this business. We sold it at a year to day. We scaled it. We ended up making 11x on our money in that period of time. And I think it was a real confident boost for, my friend John, who ran the business, and he was a great operator. So that was another example of like, I don't even know the industry, but I'm paying attention to the trends. During COVID, everyone was buying
Yeah.
dogs, and they were just a tear in their home, right? So
How
uh,
long? So you bought it, you acquired the business and then you sold it like a year later or 2 years later?
yeah, a year and a day.
Oh wow. Wow.
Yeah.
That was
So
that
then
was quick.
it
Why
was.
sell? Why not just hold on and open a couple more locations?
Well, my partner at that time, I think, was feeling like he was kind of at the end of his rope. He had some concerns that there was more competition coming into town, and he was working really hard. And so I probably would have held on to it, but I let him make that call, and so we ended up selling it. If it were up to me, I mean, it was minting money. So
Wow.
it just but it was taking a lot of time and energy, and he was putting it in. From my standpoint, it was epic because I didn't, I
Yeah.
reviewed the financials once a month. We had a monthly phone call for 30 minutes where we just kind of walked through stuff. It was so little time for me, right? Like we're talking under an hour a month,
Yeah.
um, or right around that hour. I mean, I kind of reviewed financials for maybe 15 to 20 minutes, noticed if something was off, and then we talked for 30 minutes. And that was it. So
Nice.
it was like a great gig for me. And
Nice.
so it's like seeing that. So you had asked me earlier, like, why did you transition into LP? And it was because of that dynamic where it's like, and I had started LPs before that, but it's like, well, if I'm going to buy a business where I own it, I'm going to have an operator. And then the other money is just going to go into things that have like another professional operator, right? Like I can be a limited partner, they can be a general partner, and they've got years of experience. And I know their track record. I know the history of their deals. I mean, I can learn all this information and just find the best in class out there, which I've done. And that's been a great fit for me because I really want to own my time. We're very similar in this, in the fact that we want to be great husbands, great parents. That trumps the business stuff. And
Yeah.
maybe early days that wasn't the case. Maybe early days for me, business, I was more involved, I mean, when my daughter was younger, I probably, I probably prioritized business over being a father, right? But at a certain point, I was like, no, this is the new priority, and so I want to own my time. I want to spend it the way that I think is best. I want to have boundaries around when I am and when I'm not working, and more than that, even if I have the boundaries, I want to be able to have a clear mind and not be somewhere else when I'm with the family.
Yeah.
So I'd rather have partners that are just great at what they do, so I don't have to worry about it.
Yeah, it makes complete sense. And there are just people that are just more passionate about the thing, and they're within a season of life where they have to be all in. And businesses require that all in
Mhm.
mindset, the founder mode. Um,
Yeah.
so so um, so speaking about LP, GP, or operators, when you think of like the ideal operator, what are you looking for? Like, and is there like, are there common things between business operators, real estate operators, or other GPs?
Yeah, there's definitely commonality. I mean, some of this is like, well, actually, let me just say this first and foremost. The success of the deal hinges on the jockey or the GP more than anything else, right? A good
Well,
GP
so I'm
can,
gonna I'm gonna push back on that.
okay.
This is actually a really good conversation because we just had it just a couple of days ago. You know, you and I are in the same kind of communities. We see a lot of the same deal flow. We know how many deals blew up in the last like 4 or 5 years, and there's to me there's like the asset, there's the operator, and there's the cycle, and then even within the operator, there's the cycle of the asset, the cycle of the economy, the cycle of the asset, and then the cycle of the operator himself. The operator in his fund one, fund two, or deal one, deal two are a little bit different than deal five, deal six, and the vintage is going to have different results. So yes, you 100% agree. There's that a lot of it is the operator, but also there are these other elements that are like that play into it. What do you think about that?
I 100% agree with that. So I guess maybe I should say it as if this is a good quality asset,
Yeah.
then the jockey matters more than anything. If it's a poor
Yes.
asset, actually the jockey matters. But don't ever underestimate market timing,
Yeah.
because that can get you every time, and it's gotten me before. So 100%. Similarities across the board with these operators. Well, I like people that have really good tracking and dashboards and great financials. Like, I want to know that people actually can manage the numbers, and I want to know that you've had experience beyond just one market cycle. I want to know that you've gone through different market cycles, that you've gone through recessionary times or GFC or whatever. Like, I want that track record, and I don't care what you're projecting as the numbers for this. I care what you projected in your past work, and did you hit it or miss it?
Yeah.
Like, that to me is way more important. So I agree 100%. Operator, asset, cycle, economy, timing, cycle, right? 100% on all that, because I mean, we saw it in multifamily.
Yeah.
Multifamily boomed and it was great until it wasn't. And by the way, some of this is bad operators thinking they could get in and they made money real quick inside of a good cycle. So
Yeah.
now they know everything, right?
Yeah.
So a lot of danger in
And
that.
also
But
the competitive dynamics got really tough. I mean,
yeah,
everything got too expensive. Everything got bloated. There's the ZERP era just made everything combobulated, and so there's the competitive environment. There's all that money coming at the operator that's looking for a place to be, and it's too hard to pass on. Yeah, it's a challenge. It was a challenging environment. So if you have to go back and look at that era, what would you do differently?
well, luckily on the multifamily bubble, I got out way early, and my friends gave me
Nice.
a hard time. They were like, "Oh my goodness, look how much money we made. You missed out on this deal and that deal." But at the end of the movie, I didn't lose any money in any of those deals, and a
Yeah.
lot of those went belly up. So it's like, it's kind of poetic justice to see it all play out, the way that it did play out. Uh, but you see that just like, industrial and mobile home parks have just killed it for this last stretch. Multifamily, they've kind of, that story has soured quite a bit, and pricing has come down, and a lot more foreclosures. Self-storage has kind of remained pretty strong, but the problem is it's one of the most institutionally owned asset classes. So you're not getting good pricing. But it's like each decade or each cycle, there is a different asset class that is performing, and ones that maybe performed in the prior one aren't. And
Yeah.
so you've got to be doing your market research and know the numbers and understand what interest rates do when interest rates go down versus when they go up, and the value of long-term timelines, and being able to lock rates versus variable or bridge lending. So there's just so much to learn, and a lot of people learned it the hard way. I'm glad in this instance I didn't learn it the hard way, but I learned several other things the hard way. It just wasn't this, and it's because I had learned some of these other things that I was more conservative, in this cycle and with this, specific asset class or sector.
Yeah, I mean, it's one of those things where the irrational exuberance, whenever you feel that sense of exuberance, you just have to be a seller and not, and it's very hard to do. And it's kind of like Warren Buffett talks about, the market is like this Cinderella party where everybody knows that everything's going to turn into a pumpkin at midnight, but there's no clock, or there's a clock with no arms. So you can't
Yep,
tell what time it is.
that's
So,
right.
so you're either going to get out of the party too early, or you're going to turn into a pumpkin.
That's right. Well, and I also think for your audience, you're going to deal with a lot more entrepreneurs, business owner types, right?
Yeah.
And so my observation, obviously, our lifestyle investor community, we work with tons of people that, have had exits or are currently running a business. And we find consistently entrepreneurs are the worst investors. They are
Yeah.
such bad investors because the skill set is totally different, right? As an entrepreneur, and by the way, I have learned to play the investor role differently. It's hard because it's outside my nature versus entrepreneurship's more inside my nature, meaning I want to be optimistic. I want to think the best of people. I want to think that we can solve any problem. And I project that and I fully believe that,
Yeah.
but that's not how it works in investing. So you can't be this eternal optimist. You actually have
Yeah.
to be more pessimistic.
Yes.
So early in my investment career, I was like, well, I'm a great entrepreneur. I can spot, holes. And if something goes wrong, I can fix it. And so I looked at these deals and I was like, well, this is a good deal. Let me see if I can prove otherwise.
Yeah.
Versus like now, I would never do this. I go into all my deals like this is a horrible deal unless I can prove otherwise.
Yes.
Right. So it's a
Yes.
totally different mindset. And I can't think that I'm just going to solve it or rescue it because I have limited control. I
Yeah.
have limited voting power. I have, as an LP, there's not a lot I can do. And
Yeah.
so that difference is a world of delta and success and failure, right?
Yeah.
It is a massive chasm that like the skill set to bridge that gap is massive. And if you put in the time, you can master it, but it is counterintuitive to
Yes.
entrepreneurs.
Well, it's also like the investing component. It also comes with experience because you see like the people that have been investing for 30, 40 years, they almost become like a banker mindset. Rule
Yep,
number one, don't lose the money. Don't lose
that's
the
right.
principal.
That's
So
right.
so it's like their expectation of return starts shrinking with their expectation of no risk, lowering risk. So it's like, okay,
That's
I'll,
right.
I'll take a no risk option. You're always competing with the no risk option, and the premium for that return, the risk has to be like so much higher, and it is very hard to teach or to tell someone. Sometimes you
Yep.
just have to they have to experience it on their own. So
Totally.
as you're looking at, so we have a lot of people in our community that raise capital, and they find private investors, or they go to search funds, or there are a lot of in our business acquisition ecosystem, there are a lot of ways to raise capital. As an investor, how do you think about the type of deals you want to invest in, the operators, and then also like the return profile? What are you looking for?
Yeah, I mean, ultimately, what I have done since having some exits is I have focused on really trying to learn and understand what family offices do, how they operate, specifically single family offices. So these are the people or the organizations that manage and invest the money on behalf of specifically billionaires if you're a single family office. And so my goal is to democratize to our community what billionaires do. And so I've done that for my own portfolio. I've read the data. I look at it all the time. I have access to all kinds of data because I have a lot of friends in this space and I pay for other things to just be able to see it all. And the trend, like it is so crazy how similar it is across the board, like asset allocation through and through. There is very little variance.
Mm.
And so, what I want to do, it's like when I look at these entrepreneurs, another, massive mistake that entrepreneurs make when they start investing is maybe they have a windfall of cash or maybe their business is kicking off cash and they're like, well, hey, I know how to run a business. I know how to scale business. So I'm going to invest in all these businesses. Oh, my buddy's got a business. I'm going to invest here. And they invest in all this early stage stuff. And we know the odds of that. It's
Yeah.
like, 1% success rate. So
Yeah.
99% likely they're going to fail, but they don't know that. They don't know that they just wrote an interest-free check, for an undetermined period of time and a high risk asset that's likely going to be worth zero.
Yeah.
And so, if you study like what do these single family offices do? Well, it's 1% or less of their net worth in that early stage.
Mm.
It's 4 to 10% in VC. like most people, it's funny, like anyone that's ever built a company, up through VC, whether you raise money or you bootstrap, like you understand that stage. And so you think like, oh, this is where people invest all their money. No, it's not. It is 4 to 10%, almost like clockwork through and through. And even the VC like heavy family offices are only like 12 to 15%, So it's not much. And then, you look at like public equities. So many people put most of their net worth there. The wealthiest families in the world, they're putting 15 to 30%. Private equity is actually one of the largest holdings, usually 25 to 35%. Real estate, 10 to 20%. Private credit, 5 to 15%, depending. I mean, you'll actually see private credit higher at like the centimillionaire level and then a little bit lower at the billionaire level. Same with real estate, by the way.
Oh, interesting.
And so you can actually see this stuff play out. Usually it's 5 to 10% in cash, 5 to 10% in fixed income, 1% in infrastructure, 1% in precious metals, 1% in commodities, specifically oil and gas. So a lot of people over allocate even to that, right?
Yeah.
And then usually you're seeing about 1 to 5% in Bitcoin. And so like that's it. That's the makeup. So I want to teach people how to invest that way because they don't win by taking huge risk. Like the huge risk was that you put it all on your business,
Yeah.
right? Like you made money. Most people made money via concentration, but the wealthy continue to make money and compound it based on diversification. And so the moment there's a liquidity event or the moment the business is kicking off a lot of cash, it's diversifying out of the thing that can wreck you if it goes under.
Yeah, for all kinds of reasons. And I mean,
Yep.
it could be the greatest operator and it's the wrong cycle, the wrong event.
Yes,
Yeah,
totally.
it's not a, yeah. So in terms of, so the PE component, where is that allocated to?
So you see a heavy push now on secondaries.
Okay.
So that has become really big. You got GP stakes have really become pretty popular. Some of that PE is going to be based on, the business that someone's in. So that would be part of that allocation. So maybe that's why it's bigger. But some of these family offices, they've sold all their businesses that they operate to. So you got two different pools where it's like they're total asset allocators, or they have a big business that kicks off a lot of cash, right? So it's like,
Yeah.
two different extremes. So the numbers will vary a little bit, but generally you're seeing about 50 to 60% of the net worth of the billionaires and really centimillionaire and above that is going to alternative investments, which is very telling, right? Like that,
Yeah.
people believe in the ability to get outlier performance over the S&P 500 or over different indexes or just public equities in general, but diversified in a way that even if one industry doesn't keep cranking, that the overall portfolio of those alts is still outperforming, that public equities portfolio.
Interesting. So if someone is raising a fund for, let's say, some kind of roll up, let's say, they're going to do a gyms roll up for some reason. I'm hearing a lot of these days, or some HVAC roll up. So what do you think is the best approach, to family offices to raise capital for something like that?
Well, I think you have to find the groups that are interested. So you got a lot of family offices that create their own funds and they only want to invest in their own funds. So that is probably, you're probably not going to beat that office. If they've got, a fund or two or three or whatever, they may not allocate. Also, check size. A lot of these family offices, they're not going less than 10 million and
Yeah.
many of them not less than 20 million.
Yeah.
But they don't want to be like outsized in terms of the fund, right? Like
Yeah.
they don't want their investment to be the lopsided part of it. So
Yeah.
you may lose based on that. And then it's going to be like industry expertise, and then just like balancing, like, do they need that exposure? That would be a private equity exposure. Are they maxed out on their private equity? Because
Makes
it's
sense.
a lot more systematic. So where it's like,
Yeah.
hey, we're already at 35% of net worth in private equity. We don't have room here. We could do room here in private credit,
Yeah.
but so a lot of it is going to be very calculated in how they're going to approach it. And I think, the smaller the roll up, the more likely a family office is not going to be your fit.
Yeah, yeah. No, I was talking about like larger roll-ups
Okay.
where it's a $20 million,
Okay.
raise, yeah, check. And so that's, yeah, absolutely. It makes sense. There's no point of going to a family office for a $2 million deal.
Yeah, you got to
Um,
go retail investor,
yeah.
friends and family.
Yeah, exactly. Yeah. So what are you seeing? What are the trends? What's like in 2026? What's the newest thing?
Well, I do like kind of paying attention to this data. One of the things I love talking about in my book is finding invisible deals. And a lot of the deals I've found have been because I have followed trends.
Yeah.
So, I mean, one big trend is what do millennials like to do? Because they're going to inherit somewhere around $100 trillion in the next 10 to 20 years. So,
Yeah.
whatever they like to do, how they like to shop, how they like to eat, how they like to vacation, what they do for recreation, how they like to work, like all these things are going to matter more than most people realize. So like that's one trend. It's like we know who's going to control the money, so let's learn their habits. Let's pay attention to those things. I would say, AI is going to continue to go up into the right, robotics, defense tech, gaming, esports and gaming, I think is going to become more and more of a thing worldwide. It is. I think that's going to trickle down here. I think we're going to see more onshoring. I think more stuff's going to happen around ports and border towns. I think, I mean, I actually have so many categories that I'm like so excited about and so bullish about. I still think that mobile home parks are, I mean, it's the least consolidated real estate asset class, so there's still a lot of room to move there. We're going to see more seller finance deals with interest rates high, so there's a lot of assets that we can buy that way, businesses and real estate. So that to me is pretty interesting. I think Bitcoin right now, which is not really performing well, I think in time will come back and do pretty well over the long run. I think we're going to see a lot. I mean, blockchain is going to revolutionize a lot of things. So there's really no shortage. I mean, that's just off the top of my head. I've
Yeah.
got a list of like, probably about 35 to 40 different like sectors that I'm really excited about personally. Like, I mean, even if we went into like biotech and fintech
Mhm.
and prop tech, like all that is robust. I would say like any of the gambling, gaming type
Mm.
stuff. I
Yeah.
invested early in like Polymarket and
Kalshi.
Kalshi.
Yeah.
So I think like there's a ton of room there, but like you're going to see more with DraftKings, and you're going to see more like there's just going to be more opportunities. Is that is big? I think NIL. I think more opportunities to invest as a minority investor in pro sports.
Mm.
The list goes on and on.
Yeah.
I mean, like I'm so like people are like I talk to so many people who are like scared of what's to come. I'm so excited for
Excited.
what
Yeah.
is to come. I think like there is so much opportunity to do great things in the world and advance some pretty historic things. And you and I have talked a little bit about this, and I know you believe this, but it's like we've done well financially. We're going to keep doing well financially, but we don't need to do well for us. Like it's not about more consumerism. It's about how do we pay it forward? How do we have impact on a larger scale? How do we create a better world? How do we help people level up that need that? And so that's what really excites me is like how do we figure out how to create change in the world that is very positive change and helps out that lower income middle class to kind of take a step forward and not a step back, which has been happening really over the last couple of decades.
Yeah, it's tough. It is the whole K-shape dynamic in the economy is really rough. But I think there's a lot of conversation around how to fix that and how and we need to, and eventually things swing like a pendulum. It goes too extreme this way and it comes back the other way. So let's go on the next generation. So, you mentioned family offices, and I've been in conversations and meetings with some of the family offices. What are you seeing in terms of wealth preservation? Like, what are the things they do with the next generation, with the kids and the grandkids, to kind of get them to preserve that wealth and that legacy?
Well, I think a lot of groups are still working this out, and I do think this needs to be like a major conversation. By the way, there are more family offices every year, every month. So family offices are going to control more assets, like just moving forward indefinitely.
Yeah.
That is the trend. It's many trillions of dollars. It's just going to keep growing. There are two different camps where it's like there are people that are like, hey, I want to do great things with these dollars. I don't want to corrupt my kids. So we're going to create, these trust structures with trustees, and we're going to do good things with these dollars, but it's ultimately not going to, flow down for the kids to be able to spend willy-nilly however they want. You've got another group that is kind of like, hey, I'm setting this up so my kids are, kind of ahead in this world. There's a little bit in the middle where you can do some of both, but I think there's probably not enough conversation around family governance, around legacy. I think the sooner you can get your kids into, like, if you have a family business, help them understand the family business.
Yeah.
Help them understand money, help them understand investing. Have the conversations about money. You don't have to tell them exactly how much money you have, but you
Yeah.
can start the dialogue. Like I think the conversation should be happening. We need to educate. They're not going to learn in the school system.
Yeah.
So it's like we need to teach stewardship and I think the more that kids are exposed to third world countries, and the more that they're exposed to like serving and giving, the better steward they're going to be of those resources. So I think some of it is like, some people think like legacy is that they get money. No, no, no. Legacy is the values,
Yeah.
right? Like, what are the values? How do we teach? What can we model? What can we do together? How do we actually help you, like, recognize, understand, and appreciate the value of making money and what the dollar is worth?
Yeah.
So those are some of the exercises I'm thinking about, for my daughter. And, I know like you've got a killer group there where the conversations are just incredible around kids first and what we're teaching them. And, but these are the things I'm thinking. I think too many families, too many family offices are too concerned about where the money's going.
Yeah.
And who's getting it, and not like passing down what is more valuable, which is wisdom, values,
Yes.
responsibility, all that.
100%. 100% agree with you. There's a lot of, there's strategies to control from the grave, to control through structures. And then it's more focused on the capital. But to me, they're transferring not only financial wealth, but also intellectual capital, which is the values, the knowledge, the experience. There's a lot in that IP that can transfer from the parents to the kid that we don't have, like we see it like in our businesses. Most businesses don't have very good SOPs. They don't have very good written, communication and rules and governance. Same thing in the house. They don't, as an organization, a family does not have that. They don't have that that way, how we do things, the way we do things, our values. And then to me, which is completely forgotten, there's also another element of capital, which is the relational capital.
Yeah.
So when you think of like your network and your relationships, and how can we package that so that can be transferred? For me, like when I was a kid, I would just give me that. If you have a really good network, I can find the ideas and I can find the money.
That's right.
Right? If I have the relationships and I have the trust and those are much more valuable than capital or ideas. So, and I think there's definitely a need for this conversation to be had, and we're just starting to scratch the surface. When I sit in these meetings, I'm like, oh my God, like this is like very basic stuff. And I see what the JP Morgans of the world are presenting and what the Goldman Sachs of the world are presenting to these people. It's very basic.
Yeah, I agree. Couldn't agree more.
Well, I appreciate you taking the time, Justin. Thank you for sharing your wisdom and your experience with us. How do people get in touch and get involved with your group? You have an amazing group, by the way.
Well, thank you. Yeah. So everything can be found at lifestyleinvestor.com.
Okay.
So, I've got a blog, I've got newsletters that I'm, really proud of. I've got a YouTube channel, I've got, a book, I've got master classes and courses. But what I'm most passionate about is our mastermind community and, what we've built there. Just some pretty incredible high level entrepreneurs and business types
Yeah.
that are part of it. And we get a chance to do life together, do some deals, do some tax strategy, just do all the things, and I'm
Yeah.
just trying to democratize what these billionaires are doing and bringing it down to a level where we don't have to be billionaires to do it, but we can use the same playbooks and strategies. So I just love to teach. And for anyone that wants to like learn, even just like, how do you get from point A to point B? Like, here's where I am, here's where I want to go. I'm happy to offer. We normally do these strategy sessions like for $500. I'd love to just give it to anyone who's interested for free. So
Wonderful.
if you go to lifestyleinvestor.com/consultation, someone on our team will do a free strategy session and just kind of hear where you're at and help you figure out, how you can get to wherever it is that you want to go.
Wonderful. Thank you. Thank you, Justin.
Awesome. Thanks, Jay.